Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to build their own customized tax planning playbook. I'm your host, as always, Evan Ross, based out of the Roanoke, Virginia office location of Brown Edwards and Company. I'm sure most of you have checked out our website by now, but if you have not, please take a chance to go online, check out our website. A link to that website can be found in the description of this podcast. On the website, you'll find more information on our service lines, service providers, as well as our locations throughout Virginia, West Virginia, and Tennessee. With all that, we've got a great guest for you today. We have Nagib with Revmax Investments. Nagib, thanks for being here today.
It's a pleasure to be on, Evan. Thank you for the invitation. I appreciate that.
Of course. Well, as most of you know, season 2, we're trying to give a little bit more boots on the ground, real life expertise from folks that are actually in the real estate industry, different aspects of it. So Nagib, that's why you're on today. So if you could just kind of provide a background of yourself and what you do.
Well, it's rather a diversified background, Evan. I was originally for many, many years in the automotive industry. I had a series of automotive franchise locations in the western provinces of Canada, basically Alberta and Saskatchewan. So I started there, got exposed to the business of business. And, to a certain degree, a lot of the real estate component associated with that, both from a, leasing as well as new construction side of it. And, I had an opportunity after that to join in the hospitality side in the U.S. And that turned out to be very fortuitous because really I think the primary driver was that we wanted to move back to the West on the coast. I'd born, raised on the coastline, so kind of always had a desire to go back there. So that was a wonderful opportunity for us to move into the hospitality side. So that was in the mid-1990s. And it was a wonderful experience to be able to become involved both in new construction as well as hospitality operations. And I did that with a group for, some 10 years, and then decided to go back on my own because I'd kind of always been on my own. So we did that, grew a consulting practice in hospitality, both with consulting with owners who were looking to build new assets, as well as owners that wanted to get some help in operations. So I've been in the hospitality business essentially in one way or the other since the mid-90s and kind of loved it and stayed with it.
Very good. Yep. So about 30 years experience in the hospitality industry. So you've got a great experience. I do want to, usually we start off every episode with a segment called Tell Me More. So for you, I wanted to throw out, I know you're involved with iHospitality Alliance. Wanted to kind of give you an opportunity. What is your involvement with that organization? And what do they do?
Well, thanks for asking. And, just as if I could, my involvement with Brown Edwards, which of course you're a part of, predates that very much from my experience with interacting with owners that we brought together and made hospitality hotel acquisitions, and that's kind of where we got involved with you. And alongside that, I've had a long passion with community service, going back well over 30 years, as a matter of fact. So, almost 40 years now. It's been a very central part of my desire to give back and be involved with community. And a part of that was our community has a very active and long history with hospitality. And we also have a long history of partnering together with like-minded and like industry owners in trade alliances. So the community has a long, deep-rooted history with bringing owners together that have similar industry experiences and who are engaged in industries that are similar to be able to bring scale and the benefits of best practices. So that is a deep-rooted tradition, but we didn't have that in hospitality. So, a number of the community leaders reached out and said, hey, look, we really want to be able to leverage this in the hospitality industry. Would you mind making a concerted effort to bring owners together and bring the benefits of best practices, industry knowledge, as well as scale to be able to really deliver some of those advantages to owners that may have, a handful of properties as well, as opposed to owners that may have, 20, 30, 40 hotels together where scale comes with that. So that was the impetus. And so we put together a group of passionate hoteliers to the board of iHospitality. And subsequent to that, we've had a great deal of support from community hoteliers. And we're kind of trying to achieve our vision, bring them together, bring scale, and leverage the knowledge and the experience that comes with that to benefit all other owners.
Great. Well, thanks for sharing that. I obviously had the opportunity back earlier this year in June to come down to your annual conference in Houston, Texas. So I really appreciate the opportunity to be
And
involved
thank
with.
you for your support, Evan.
Of course,
Much
definitely. I'd
appreciated.
love to come back in the future, but it really was great. Just to reiterate what you're saying, it was great to see the relationships within that group and all different sizes. You've got those hoteliers that have one or two properties just getting started, or those that have 40, 50 properties. So it was great to see those relationships and the sharing of knowledge at that conference. So with that, I'd like to move on to more the technical piece of this discussion, speaking through the hospitality industry. So as far as we mentioned the development and then the actual operations of a hotel, can you speak on both of those, the differences between those and kind of the metrics used during each phase?
Yeah, that's it's very interesting because the interesting part of the hospitality industry is that it straddles both real estate as well as ongoing business operations. And from that perspective, you attract people that may have an experience in one or the other or both, but certainly the industry is a blend of both of those realities. It delivers the the asset value growth that you see in real estate, which, in one way you could say compares to, let's, for example, say multifamily, except that it brings the business dynamics where your asset, your rooms are being priced every day. Multifamily looks at, annual lease renewals, whereas in hospitality, you see that room being priced every day. So you're a very real time barometer of the demand in your market every single day. The business side of it is to be able to put together the mechanisms and the tools to be able to price that room. And the technology, really, to be able to price that room appropriately every day and maximize your returns. It's the operational challenge of being able to do that efficiently and effectively. So everything to do with, human resource, managing associates on an ongoing basis, maintaining your asset and the capital that it takes to do that, leveraging the brand relationship so that you can take maximal advantage of their scale, their booking engine to be able to drive business to you. And then, of course, on the flip side, you've got all of those real estate elements that come into it because you've got a significant real estate asset. You've got taxes, you've got maintenance, And then on top of that, you've got all the financial metrics that go with it, typical of any other real estate investment that you have to be so very mindful of. So all of those sort of combine and come together in the hospitality space, which makes it a very dynamic and exciting space to be in. So we face the exact same challenges that any other real estate developer would have, right? You've got the cost of financing, you've got how much leverage you're going to have, and what kind of returns you're going to have, and how are you going to meet all of those financing metrics. Are you an attractive class for a lender to partner with, right? And coupled
Definitely.
with that, not only do you have their considerations about the asset class, but there are also those components that have to deal with you as an operator. How good an operator are you? And what's your history? Have you been a successful operator? Have you been able to maximize the assets that you operate? So those are really critical components that impact how you as an owner can operate within the space.
Very good. I will say, so do you, on the development side, do you typically see more ground up development, or do you see taking over an existing property and retrofitting that to your brand? We can speak on brands as well, but do you see more of ground up or modifications to properties?
So that's a really interesting question, and it changes over time depending on market conditions. So historically, the industry has a roughly 2% supply growth norm. That's kind of been the norm. Currently, we have, in the neighborhood of 5.3, depending on which study you look at, perhaps about 5.3 million guest rooms in the market. And the new supply growth rate typically has been around 2%. But over the last few years, that figure has been hovering anywhere between 1.2, 1.3%. So it's dropped. It's
Okay.
significantly below what is the historical norm. And a lot of that has to do with the cost of capital. Cost of capital, needless to say, drives that hugely. So for new construction, it's the cost of land, it's the cost of construction, which has grown significantly from, you know, take going back a few years, you could build a select serve hotel, let's say for, 125, maybe 140, 100 or so thousand a key. Well, today you're looking at a $200,000 or higher. If you're talking about a full service hotel, today the cost of building a full service hotel is, anywhere from $400,000 to $500,000 a key. If you're talking about luxury, you're $1 million a
Even more.
key for a resort,
Yeah.
right? So the scale of dollars that it takes to build a new hotel has really, really escalated hugely. Then you layer onto that the cost of financing, and you can, you go from the days of 4 or 5% to now 7, 8%.
Yeah.
If
No
you're
more.
talking new construction,
Gotten a little better, but yeah, it's not what it was.
it's not what it was. So what that has done, Evan, is it's taken and made the cost of acquiring existing hotels and, renovating them more attractive.
Okay.
So you see a lot more activity in acquisitions and renovations than you do in new construction, because to make the math pencil out for a new construction means that the type of hotels is narrow. You really need, for example, some of the metrics that you hear in the marketplace are for every $100,000 worth of new construction cost, you need an NOI of at least $10,000 in order to make the math work.
Mhm.
So you got a select serve hotel that is going to cost you 200,000. Typically, you're going to need $20,000 worth of NOI to be able to make the math work for new construction. So now you've really got to look at the market, you've got to look at the product, You got to take a look at the cost of construction and say, do they fit in those parameters in order to make the math work? That narrows the number and types of assets that warrant new construction. It's a lot more economical, for example, to go in and buy an existing asset which is significantly below replacement cost, and you say, okay, so I'm going to buy an asset for $100,000 for full service, for example, 150,000. I'm going to invest 50,000 in that to renovate it, which will take my per key cost to, let's say, 200,000, and maybe the math will work better in that scenario versus trying to build a new one at, say 400 or 500,000.
Yep. That makes perfect sense. And also, I mean, there's only a finite amount of land out there. So as far as location, you may be limited as well as far as undeveloped land versus an existing
But
asset.
never discount the fact that new and shiny is very attractive.
Yeah, definitely.
People,
And you may, I'll mention as well, just with the one big beautiful bill that got signed into law back in July of this year, with cost segregation. Obviously, that's been around for a while, but there could be a way to get more deals done with new construction with bonus depreciation going back to 100%, potentially.
absolutely. And that is a huge source of capital in our industry. The fact that you got high net worth individuals investing in as LPs, for example, in a project, they get the benefit of number one, the depreciation, which is huge.
Hmm.
And number two, if you've got the right kind of project, you've got a cash on cash return.
Yep.
Another huge benefit. So yeah, if you find the right kind of if you kind of the right kind of development, whether it's new development or existing development that you want to renovate, the benefits are very significant.
Definitely. And yeah, and like to your point, you can do a cost segregation on whether it's new construction or an existing property. That's still feasible in both scenarios. So yeah, thanks for sharing that insight. I'll go back to branding. How does that work in your industry with selecting a brand, with a brand agreeing with you? How does that process work?
So if you're doing so maybe I can start by saying that the brands will issue a franchise license that will typically have, let's say, 15 years. Okay, it depends on the asset, it depends on the age of the asset, but let's say 10 to 15 years is a fairly normal term for a license agreement. So that you start with that. Now, once you have a license on an existing asset, and let's say that you go ahead and sell that asset. Let's say we're buying one, and we're on the other side of the equation. We buy an asset that may have originally had a 15-year term. So now the existing owner is saying, I want to sell it. I'm maybe 5 or 6 years into this term, and we step in as a buyer and say we're interested in acquiring it. Typically speaking, you're going back to the brand and you're entering into a new license agreement for, let's say, another 10 or 15 years.
Okay.
So now that asset is essentially encumbered to that brand for
Very good.
another 15 years. And then I may have it for, 5 or 7 years, and then we go and we sell it, and the cycle repeats. So what
Resets again to that 15 year. Okay.
Correct. So what happens is really that asset that started out with being encumbered for a period of 15 years might actually end up being encumbered with that brand for much, much longer than that because of the acquisition cycle that keeps happening.
That
Now,
makes sense.
once you're associated with a brand, you may be able to move up in that brand or move down on that brand, just depending on what is the most suitable positioning for you to be within that brand. And the brands will generally be more amenable to you staying within the brand because the value for them is huge. If you're generating, $150,000 in fees for that brand a year, the amortized benefit of that is massive. to the brand. So they really want to keep you. So they will work with you to either scale up or scale down, depending on which one of their brands is best suited for the market that you're in.
Okay.
However, you may say, look, I don't want to be with that brand. I want to switch brands because there's a better opportunity for me to drive more revenue if I switched from, I don't know, maybe let's say Choice to a Hilton, or from a Hilton to a Marriott. Well, then you get into the situation where the brand is going to either allow you to do it at a significant cost, or they may simply not allow you to do that. So you really have to go in and say, if I'm acquiring an asset or I'm building an asset, I want to be very thoughtful about what is the demand in that market, and does my brand speak to that demand?
Very
And
good.
if I'm in a Hilton product, is my particular brand within Hilton the correct one? Or do I say, do I want to switch? Can I do it, and at what cost? So brand is critical because 50%, 55, 60% of your demand is coming from the brand. So it's really important that you select not only the right brand, but the right product within that brand that will maximize both rate and return for the kind of market that you're in.
Yeah, that makes perfect sense. I mean, because a lot of consumers, they are loyal to certain brands over other ones. So definitely need to do your due diligence. Sounds like before you get into um, one of these licensing agreements, because it does sound like there is. If you want to switch, potentially it can't be done, or it's going to be a significant buyout and cash outflow that you're going to have to be willing to
Absolutely.
move forward with. So
And lenders are very, very mindful that the brand that you're affiliated with is a huge part of the security that they have. Because if, 50, 60% of your demand is of your sales are going to come through the brand, they have a very vested interest in making sure that you're secured with that brand and that they're going to be able to
yeah,
continue to deliver that kind of demand.
makes perfect sense. So it all ties together. I'll stick on the branding for just a minute. Obviously, you go to hotels, you're always seeing renovations and upkeep and things of that nature. Are there specific requirements by brands to every 5 years, 10 years on a scheduled basis do upfits to a property?
Very much so. The typical renovation cycle, Evan, runs around 7, 14 years. So
Okay.
7, 14, 21 is kind of the life cycle that most of them will adopt. So generally speaking, what they want is they will have in their franchise agreement a requirement that you reserve a certain amount of your revenue every month. Typically, that's between 4 and 5%. And they'll require that, and the lender, for the most part, likewise will require that. So what they're going to do is they're going to, in many cases, build into their uh, loan terms with you, have a reserve for FF&E, just as they will have a reserve for insurance, just as they will have a reserve for real estate taxes. So that FF&E reserve, typically industry-wide is around 4%. And you have to, generally speaking, do a soft good renovation every 7 years, which is, carpets, wall vinyl, lighting, uh, carpeting. I mean, those are generally soft goods that see a lot of wear and tear. And every 7 years, the brand's going to say you need to replace those. And then every 14 years, you got to do that again. So, in other words, change all the carpets, wall vinyl, soft seating, lighting. Uh, Plus, you have to replace your case goods, which is your headboards and your armoires or any other desks or any other hardwood components that you have. Those have to be changed every 14 years. And then the cycle repeats every 7 years, you're changing the soft goods and case goods. So you have to be able to account for that capital investment every 7 and 14 years, with 14 years being the bigger one. Industry tells us that the 4% is not enough. Industry calculations, generally a lot of studies that have been done show that you almost need around 9% reserve if you want that reserve to fully cover the cost of those renovations every 7 and 14 years.
Okay, thanks for that. Yeah. So, do you ever see instances where, so obviously that 4% reserve, that's the required amount that a lot of the brands and banks are requiring. You're saying 9%. Are there instances where they're having cash flow issues and they have to take out another loan to finance those renovations, or are most hotels pretty sufficient to cover that 5%?
I wish that was the case. This is the cause of a lot of the pain that the industry has been feeling.
Okay.
So coming out of COVID, of course, everything got sidetracked. All of the norms all the wheels fell off, and interest rates rose. A lot of the capital expenditures were extended. The timeline was extended, and now you're in a situation where, the brands are saying, "Hey, look, we've given you a get out of jail free card for a few years," and the guest is telling you, "We don't care about COVID.
Yeah.
You want the rate, we want the product." But as an owner, we're saying, well, that's great, but a lot of these markets haven't come back.
Yeah.
It's changed. The whole dynamic of the industry has shifted. And money is not at 4% anymore. It's, 7, 8%.
Yeah.
And a lot of times it's very challenging to make the math work. So you got this tug of war going on between the brand and the owner.
Yeah.
The brand said, you know what? The guest is hammering you on your scores, which looks bad on us as a brand. When they come to, a Marriott, they have expectations. And if you don't live up to those expectations, then it's bad on us, it's bad on you. And so guess what? I got a stick. I'm coming at you. You need to do it. And the owner is saying, I would love to, but I can't fund it. What do I do? So you now have this situation, which is very challenging. So what typically the owners are doing is they're saying, I'm writing the math and the investment thesis on an asset to say 5 years. 5 years falls short of the 7-year window. So what we're saying is, look, for 5 years, I'm going to grow this asset, I'm going to grow my revenues, and then at the 5-year point, which is typically your funds cycle, I'm going to exit. And the hope is that when I exit, the new owner coming in is going to say, okay, I've got to do some of this work, but the property has shown sufficient forward-looking momentum that if I do the renovations, I'm going to gain in rate. I'm going to drive enough additional rate that I can compensate for the cost of the renovation and still make sure I get my return. And that's the thesis that has driven this industry all along.
Yeah.
And as an investor, you've got to sort of anticipate this and say, look, can I drive enough growth over my 5 years to be able to make the investment work for my owners? And yet, at the end of that 5 years, is the market going to make sense for an owner to come in and say, I can pay you the price that you need, plus I can absorb the cost of additional renovations, compensated by the fact that I'm going to get more rate. And so it works for that person who then 5 years from then is going to be in the same scenario.
Yep. It's obvious you've been doing this for a long time, because there's definitely a lot of strategy and analytics within this industry, making sure you get the right return on investment, and when to get in and when to get out is what I'm hearing from you.
Well, that was really critical, and it has become, COVID changed all of that, because that whole theory that we all operated on kind of got upended. So So, lenders were different, brands were different. So there's still a lot of people that are, upside down in the industry and are trying to navigate their way through that. Uh, a lot of hotels haven't gotten back to pre-COVID days in real terms. And there are others that have significantly exceeded that because their market suited what the consumer is looking for today.
Great. Yeah, I'll go back to something you mentioned kind of earlier on in our conversation. You mentioned price and how that's much different than um, typical multifamily or single home lending, where it's an annual lease. Hey, this is what you're going to pay for the year. Your prices are changing daily. How is that determined? We had an episode early on in season 1 of this podcast related to artificial intelligence. Are you using any type of AI with the pricing, or are you using some other system to get those daily rates?
It's a critical component of the industry. It really is. Um, so revenue management is the term that's used
Okay.
to essentially price your room correctly. And there are various components that come into this. Number one is, any events that are occurring in your marketplace, obviously, hugely impactful. You got a big concert coming in, massive boost, right? You got a
Yep.
Taylor Swift coming anywhere near you, and
Yeah. Sold out.
it's manna from heaven, right?
Yeah.
I wish he was touring all the time. But
Yeah.
events like that, be the sporting events, be the concert events, or any other activities like that, are a huge boost. So you really have to watch the market to see what is the demand, what's the amount of influx going to be, during that period, how much demand, how many rooms there are in the marketplace, and then that tells you how you price your rooms. But even outside of that, outside of these big significant events, there's the ongoing cycle. So pre-COVID, if you were a corporate hotel, Monday, Tuesday, Wednesday were gravy days. That's when the consultants like you were coming into the market. You had to be there, you had to visit. And so, we drove our rates up during that period. But then Thursday was kind of a dog because usually people are kind of going back home and nobody wants to stay on too late. So if you get your work done, you're gone, right? And then on Friday and Saturday, you get the leisure traveler that comes in. So that kind of dictated how your rates fluctuated during the week. Post-COVID, that cycle that we depended on has significantly changed. So now, because a lot of people, I mean, you're not traveling to a market where your customer isn't in the office. So that kind of went out the door.
Yep.
Now you're seeing that coming back. So you're seeing a little more of the typical corporate traffic beginning to come back. So you use that to gauge what your rates are going to be. To your point about AI, the industry, the brands have built a lot of this into their model. So when you're working with their property management system and you subscribe to their rate plan, their engine on pricing, artificial intelligence is a huge part of that. That is looking at it's surveying your landscape constantly over the course of the next 365 days. It's looking at what kind of demand. Has there been any event scheduled? What happened last year? How many rooms did you pick up in a 30-day window, in a 7-day window, in a 24-hour window, taking all of this into consideration and suggesting what your room price should be. It's a massive, massive part of the strategy.
That's great. Yeah. Well, thanks for sharing that. And I really appreciate all the insight today from the operations, the development, the branding. I think it's great information for our listeners out there, whether they're just getting into this industry or if they've been here for 30, 40, 50 years. So I want to give you an opportunity, Nagib, if there's anything additional you'd like to share on the podcast today that we didn't cover.
Yeah, I'd just say that it's a such an exciting industry. It's dynamic because it's every day is a day. Every day is different. And so it's a very exciting industry to be involved with on a day-to-day basis from an operational perspective. It gives you this sense of, what the market is doing real time. Because if there's a change in the economy, you're Main Street. You're seeing that, you're experiencing it. We're looking at, corporate demand may be different from transient leisure demand. And so as the economy changes, you feel that. You also have an opportunity to experience the investment cycle, from the financial side, right? You get to appreciate from an investor perspective, what's important. What's the return going to look like? What's the tax benefit like? And so you get a sense of that, and you're transacting with the financial community. So you're always having to be very cognizant of the realities of that world and how that impacts you. So it's really fascinating. But at the end of the day, you're an operating business, and working with associates to be able to make them feel engaged and to deliver the experience to the client and the guest that walks in, at the end of the day, that's where the rubber meets the road. So it's very exciting because you're really hands-on with people and their realities and making sure that, they share the passion that you do to deliver the experience, because your ability to drive rate has everything to do with the experience that the guest has. So at the end of the day, it doesn't matter who you are. That's where the rubber meets the road. It's that experience that the guest has that decides pretty much everything about how successful you're going to be.
Great. Well, you can tell you're very passionate about what you do in your day-to-day life. So that was part of why I wanted to bring you on here, to share your story and your expertise. So again, would you like to share your contact information if any of our listeners are interested in contacting you?
Absolutely.
Questions?
Thank you. The name again is Nagib Lakhani. Our website is www.revmaxinv.com. And my email address is the same, nagib@revmaxinv.com. And happy to chat with any of your listeners if they have any questions about anything we've talked about. And Evan, thank you. Thank you for your support. It was really great to have you there and talk about the benefits of cost seg and, the really very substantial financial benefits that accrue. So
Yes.
thank you so much for your support for iHospitality. Really appreciate that.
Well, happy to do it, and hopefully I can come back at some time in the future. So, well, that is a wrap for this episode of the Real Estate Tax Playbook. I appreciate everyone tuning in. As always, make sure you like, comment, and subscribe wherever you get your podcast, whether that is Apple Podcasts, Spotify, YouTube, or some other platform. We look forward to bringing you more content on season 2 of this podcast.